Hey guys, it's Pipionaire here. So today we're going to be covering Pipionaire Systems, FTMM 2.0, Pipstronomy Phase 1. So it's basically going to be just covering the basics and like just the essentials, and then I'll give you guys some examples as well, and then we'll build off. And so this is just the first stage. So there's a lot more phases or stages, whatever you want to call it. So it's just the basics. So don't think you're going to get some gold nugs right here, to the golden holy grail of trading or whatever. It's not going to be as easy as that. Otherwise everyone will be rich. So we start off with baby pips. I tell all my guys to start off on this resource because it's free. It's for everyone, and it'll give you a good foundation into trading. So just go to education, and from there you can click start course, and you'll be on this page, School of Pipsology. So we start off with preschool. In preschool, just the basics. I'm not going to go over any of these, like what is forex, how do you trade, when can you trade, who trades it, and so on. It's basically going to give you a basics, like a basic introduction into forex. It's essentially like the language of forex. Like if I were to teach you something, it's gonna be the language of how to read it. Like what's a pip, what's a candlestick, what's a lot size, and so on. And once you learn the language, you can learn to write, and that's how it works. And that's essentially what preschool covers. So that you can do on your own. It's really no sense of me wasting my time teaching you guys the basics when it's all there for you. The next thing is kindergarten. I tell my guys to skip this. It's not really necessary. Like this type of stuff, you can really learn after. It's not essential for you to begin trading. Elementary. So for elementary is, I only say look at grades 1 to grades 3. So grade 1 is support and resistance. It's quite simple. So we can look. I'll give you guys some examples. We look at this chart. We can go to any time frame. We can start on the monthly. Support is basically like a floor, and resistance is basically like a roof. So anywhere we can see there's a floor, right around here, there's a floor area that's respected over here, maybe right around there. There's your support zone. Delete that. For resistance, like around this area is respected by this, respected against once again, and respected nearly once again. That's like a resistance area for the very basics of it on the monthly time frame. Go on the daily, you can see as above, so below. So price action patterns are going to repeat themselves over and over. Just a quick example, right around here, another support area. Respect it here, come back and respect it, and so on. The support finally breaks, and then it's retested that it's resistant. We'll get to this later. That's support, and this could basically stand as a resistance area. It's like a roof. Hits the roof again, come down, hit the floor, hit the roof, and so on. So that's like a really basic introduction for support and resistance. Japanese candlesticks. So these are basically the patterns. Like each of these individual patterns, like these individual candlesticks, usually makes a pattern. So to the untrained eye, it might look like a mess. For the trained eye, there's a lot of patterns here. Like a bearish engulf, evening star pattern, hammers. This is a pattern right here as well. I know more what they look like, less about the names, like morning star, and so on. You can just search up like Japanese candlestick patterns, and there's a few that I prefer over others. So if you can quickly go to Google, let's find the picture. It's not the best picture, but let's see, like this bearish engulf, that's fine. It's like this bearish 3 line, so I don't really look at that. I just look at the bearish engulf. I don't really use this. I don't really use this. I don't really use this. So bearish engulf, yeah, I'll use that. The evening star. So these two are really major key for my trading. The hanging man, kind of useful. I prefer just looking at the wicks, like hanging man, inverted hammer, so on. That doesn't really matter. What the wicks really showing you. The same thing stands on the opposite side. So where it's a bearish engulfing, it could also be a bullish engulfing. Where it's a evening star doji, so this right here could also be a bullish morning star doji. And these are basically reversal patterns and so on. So yeah, these are Japanese candlesticks. There's a lot more patterns. Like bullish tweezers are also really good. Same with bearish tweezers. It shows you that price pushed up, sellers came in, so they closed bearish, and then price pushed up again, sellers came in and they closed. So we could not break this level. And then what comes next? Big melt. Over here, what comes next? Big push up, and so on. And over here with Morningstar, it's like a big push down. A lot of sellers in control. Doji, so there's indecision. Sellers have exited the market, but buyers have not yet entered. And then boom, buyers take over, and so on. What continues? The buyers who took over, and so on. So we can find a couple of these examples. Like right over here is like it's pretty shitty, but it's an evening star pattern. Right over here is another morning star. So bearish, kind of like a doji, and then boom, engulf. And it continues up. And this happens a lot of times. Right again over here, it's like a bullish hammer, as well as like a mini morning star. And that's pretty simple for Japanese candlesticks. You guys can study more on your own. So I don't want to make this video too long. Grade 3 is Fibonacci. So Fibonacci isn't going to be the best to teach yet for beginners, but I'll give you guys a brief explanation of what Fibonacci is. So Fibonacci is basically the key to the universe. So it's basically how price moves. Price likes to move. As much as people think it moves randomly, there's a lot of order to the randomness of the charts. It's Fibonacci is like, if you look at your finger, there's Fibonacci on your finger. If you look on a fruit, there's Fibonacci on a fruit. If you look in the sky, there's Fibonacci in the sky. Fibonacci is everywhere. It's basically the code of the universe, if you were to say. And it also applies in the charts. So the way we start it is, we start from the start of a trend, the very end of a trend, a big impulsive move. Actually, I don't have all my levels on this because I change it up for the pairs I'm looking at, just so I can remove noise off the chart. So levels I like to use are 38.2, 61.8, negative 0.27 for TP1, 61.8 for TP2, level 50 fib, 78.6 fib, and so on. So we can see over here, I don't want to draw the 100% or the 0 just because I want my charts to be clean. So we can see price goes from point A to point B, pulls back to point C, and it finds support right around 38.2, does a stop point to 50 fib, and continues up. So you can look at this as an ABCD pattern. A, B, C, D. I don't really draw this stuff on my charts, but I just know it mentally, but it is what it is, right? If it helps you visualize it, go for it. So A, B, C, D. So basically it gives you a really good risk reward. Like if I were to enter the trade right around here, and have my TP set at 100% retrace, and my stop loss below the wick, I'd get a good 3.6, 2.5 risk reward. And that's good enough. And it applies on every time frame. This is the 4 hour. Let's go another pair. Let's go to GJ. Actually, GJ had some crazy news. Let's go to AJ. So some data reading off the chart. And we'll go to, yeah, the 4 hour is fine. Let's see over here. We gotta move down, a nice reset, so we can start the fib from the bottom of the trend to the top of the trend. You can see price did a big impulsive move up, came up, and found support around the 38.2 level, and right from this level it went up again. So it's A, B, C, and D, right to TP number 2 at negative 20.7 fib. So we can, once it makes an impulse move correction and another impulse move, we can add on another fib. So from the start of the impulse to the end of the impulse. And so same thing, A, B, found support around 38.2, did a stop point to 50, and then boom, nearly all the way to negative 27 fib. So it's basically A, B, C, D, resets, so it's A, B, C, D, and then once again, start of the impulse to the end of the impulse. This time it came lower to the 61.8 fib, and it eventually did touch the negative 27 fib, but it started getting consolidated. And you can see, like, after the moves, after it does ABCD often, market's gonna tend to slow down. The volume is gonna really slow down because people are trying to get on the trend. So banks obviously don't want to just keep on following perfect fibs like they did over here. You know, it didn't break 38.2. Over here we had a little stop point, and over here we came all the way down, and so on. You can basically see once, like, basically this trend breaks, we draw fibs to the opposite side. We draw fibs from the top of the trend to the bottom of the impulsive move, and so on. So it's 30.2 found resistance, but it did not come all the way down, showing the buyers were still in control. And so we can look at the overall bullish move. It's cycles inside cycles, so you always got to be able to adapt. So you can see from A, B, C, so we found support around 50 fib. So buyers came in again at this area. So buyers no longer wanted to enter here, but at this level, the demand was higher than the supply. Therefore, buyers were waiting there, and boom, big rocket move up. It actually came up, correction down, and then boom. accumulation. That's a basic introduction on fibs. I'll show you guys a quick Fibonacci pattern, like fib A, B, C, Z. So it's kind of like, a good example will be fib A, B, C, D. This is the fib that we're catching at the C and writing it out to the D. A, B, C, D, and so on. These examples can be found in many pairs, like every pair you can find it. Let's go to gold. I'm currently in this trade right now. So it's this trade is 61.8 reversal. So the fib is drawn from A to point B. A, B came down, found support around the 78.6 level. Had a big impulsive move, retest, a lot of exhaustion, so I entered right around here. Currently floating around 44 pips in profit. Risk rewards 1 to 5 for this trade. So yeah, I'm gonna let it run. But you can see it's A, B, C, D, and it happens over and over. You can look at the past. It happens. Basically every single move that happens is Fibonacci. Just look at the impulse move. Impulse move right here. Boom, stop on the 78.6. Find support around 61.8 and melts down. Like even if you catch, you can always get 1 to 3 risk reward. So if you enter around here, stop loss above the wick, you easily catch 1 to 3 for sure. Like 1 to 3 is guaranteed, but of course you can extend it a bit longer. Over and over on every time frame. I can go to 15 minutes, and we'll always find fibs. Just gotta see a big impulsive move, past the retracement. So right here, big impulsive move, boom, huge wicks, buyers entered, the banks entered, boom, move up, retracement down, found support on the 61.8 golden level, then a double bottom, fucked around a bit, and then boom, take off. That's why you gotta always let the trade play out, and you can't rush it, A lot of people to close your trade, but you gotta let the trade play out, let the odds play out. And that's the only way it will go in your favor in the long run. Like 1 to 4 risk reward easy, and you played it out to the negative 27 fib, you would have caught nearly 1 to 6 risk reward. That's good for fibs. And I don't really look at moving averages because they can often misguide you, as in you might be in a buy and you might be trying to sell, so you might close your profits early. And sometimes they might be right, sometimes they might be wrong. So I prefer not to play with them after backtesting them and finding that they're not really helpful for me personally. And same with indicators. I really avoid indicators as they can mess with my intuition and also mess with my psychology while trading. Like it might make me want to close the trade early when I should let it run, or actually hold the trade when I should close it, and so on. So this is enough for elementary. And then I skipped middle school for now. We'll get back to this. I have some important chart patterns and so on, but I don't really use this. I don't really use pivot points. Chart patterns potentially, but we'll get to this later on in another stage. We're going to skip this for now as well. We'll get back to this. Elliott wave theory is really good, but we'll get back to it later on. We don't really need it for now. I don't use harmonics at all. So high school, I don't tell everyone to cover everything in this. I don't recommend using divergences. I don't teach my students this. So we can look at the market environment. So market environment is really key because you might have good analysis, but your analysis is really dependent upon the environment that you're trading, because some environments are going to be ideal and some environments are going to be horrible for trading. And the key is to trade a certain setup in a certain environment. Okay, some environments are good for certain setups. Like some environments are like trending environments are really good for Fibonacci setups. And you can see when the market is trending, right over here, Fibonacci is going to be really helpful. Like on the small, like suppose we're in a big trend, boom, big impulsive move. At that point, right around there, it's a trending environment. It would be a good time to buy the trend. But sometimes the market's going to be consolidating. It's going to be consolidating market. Like for example, right around here. At this level, it's better to buy tops and bottoms because when it's consolidating, you're going to get better risk reward. and so on. This usually happens during NFP week. NFP week is usually consolidating environments until the very end, of course. And during regular weeks, it's a lot of trending environments. In trending environments, ABCDs often happen, but during NFP week and like other news times, we often do a lot of 100% retraces because buyers, like, just take into account, like, an example over here. Like, suppose this is all we have. Buyers are going to be waiting at 38.2, waiting at 50, waiting at 61.8. So once price comes down to the 50 fib, look right here. Some wicks point, people are going to be buying it. And banks know that, you know. They also make a double bottom here. What do banks do? They need liquidity. There's not enough liquidity here for the banks to move at the time. And it's also, you can see, it's the middle of the month, and so on. So it depends on the weekly candlestick as well, if it needs to make a wick or not, and so on. So boom, banks break right through, come down. People are waiting at 61.8, they smash to 61.8, come all the way down, tap at 78.6, before finally doing a big move up. So you can see how early buyers would have got bodied over there, would have got bodied once again over there. They would have finally caught it here. And that's why the market environment is really important, because in the wrong environment, Fibonacci will screw you over. Because sometimes market likes to do 100% retrace. And 100% retrace is basically like over here. Suppose A down to B, B over here, C over here. So a lot of people have been getting fucked up all the way as it's going up. People have been selling, banks would have been robbing them, and so on. So there have been 1 robbery, 2 robberies, 3 robberies, finally a 4th robbery, and the 5th time they finally melted. And that would have been an optimal sell. And this is like a consolidating environment. You can just tell looking at the trend over here. Super slow, super. It's not a big, smooth, impulsive move like over here. Boom, smooth. Boom, smooth. Here it's kind of iffy. So you can tell it's a consolidating environment. So it's likely we're going to do 100% retrace all the way back to 100% level before melting. That's a good basic introduction on market environment. Now, I also avoid trading breakouts and fakeouts. Retail mindset, you're gonna get slaughtered like most retail sheep, unfortunately. So I really avoid trading breakouts and fakeouts for sure. You know, you want to trade against what the average person is doing, because 95% of traders lose. And what are they trading? They're trading breakouts, they're trading fakeouts, they're trading break and retest. Break and retest is probably number 1, and that's why they get slaughtered. Like, fakeouts are fine, but you don't want to always rely on trading a fake out. You know, oftentimes you're gonna miss a trade, so you gotta really align everything. So I also, the fundamental analysis, I don't really look into it too much. Like, I'll look into news on forex factories just so I can avoid my trade. But my perception is this, that the fundamental news will always show itself in the technicals. So if there's very big bullish fundamental news, the market is going to go up. You're going to see the technicals. You're going to see technicals making patterns, making higher highs and higher lows, and so on. It's going to show you it's a trending environment. And of course, you're going to look for a technical entry point. You don't want to just get a fundamental entry point at a random middle area of buys where there's no liquidity and so on. So that's why fundamentals, they're important, but for my type of trading, I prefer technicals. And a lot of time with my technicals, I'm able to predict the fundamentals before they even come out, because the technicals are based off supply and demand. So therefore, like, I'm able to, like, maybe 70 or 80% of the time, predict the direction of the major news, just because I know where the orders are going to be. I know where the banks are looking to hunt out buyers or sellers and flip the direction against the retail traders. So that's why I really avoid fundamental analysis. Besides looking for news, so if I'm going to trade, I can tell my stop loss and break even, or if it can lessen my risk. Currency crosses, you can go over it, but it's pretty basic. I'm not going to cover it. It's like, if it's the UJ, you're going to basically trading the US dollar against the Japanese yen. So if the US dollar is strong and the Japanese yen is weak, it's going to go up. If the US dollar is strong and the Japanese yen is also strong, then it's probably going to consolidate, as it does oftentimes, like areas like this, because there's no really buyers or sellers. So supply and demand is kind of even for the moment until supply finally takes over, and boom, supply is higher than demand, and it freaking drops. So yeah, that's for currency crosses. You guys can go over this for yourself. Multiple time frame analysis, this is also important. So this is important because you don't want to just be entering off like the 15-minute. When you have higher time frame confluence, it gives you more leverage on a trade. It gives you more confidence on a trade, more confidence on a trade, confidence and confidence on a trade, and it's also going to provide you with better entry points. Like for example, this is a major daily supply zone right over here. So I like to color code blue for daily. And you can see, suppose you're trying to set, like, it's also a head and shoulders pattern, like shoulder, head. So up until yesterday, this was a shoulder. So people would have been selling it. It would have also been Fibonacci. Technically, to the retail trader, it would have been. So it would have been 78.6 now. People would have been like, oh, it's a reversal, 78.6, let's sell it. Boom, they got slaughtered. And why is that? That is because of this demand zone over here. Price has touched the demand zone. So if you're looking at the small time frame, you would have got slaughtered. But looking at the daily, you can really tell that, okay, since look at the daily candle, it made a huge bullish candle. So there's a lot of buyers in the market. So we might potentially come down and start going up. Or we might potentially, we have to wait for like a doji or some exhaustion, like over here. Boom, engulf, impulsive move, doji, exhaustion, and then a melt. Stop hunt over here as well. Same thing. There's no doji, so if you didn't look at the higher time frame, you would have got slaughtered. And it also helps. Like you can look at this supply zone right over here. I mean demand zone, my bad. Supplies here, demands here. And just to catch this trade, you find the daily supply zone. So now on the 4 hour, you look for a pattern because you're not going to just buy it off the daily, right? So on the 4 hour, it makes a shoulder here, a head over here, another shoulder over here. So reverse head and shoulder. Shoulder, makes neck, head, neckline. If you got like a trend line over here as well, you know. And once this breaks, it gives you good confirmation you're in the right trade. And if this holds, you know, to get the fuck out. This is the head. This is the shoulder. This would have been a really good entry point. But just based off the 4 hour, it's kind of hard to find an exact entry because you know you don't know where you're gonna be. Like you might be here, thinking is it gonna just go from here? Is it gonna come down here? Is it gonna make a double bottom or so on? That's why it's good to come with a smaller time frame. So over here we can go to the 1 hour, and finally we can find a really good entry right around here. So we do know that it is a right shoulder. So it's the first shoulder, it's the head, and this is the right shoulder. So we could have had a really good trade over here as well. Could have been like a smaller head and shoulders, like within the bigger head and shoulders, there would have been a smaller head and shoulders, right? So it's like as above, so below. So whatever. We could have got a trade right here. Two huge dojis, hammers, engulf, retest. So you could enter it anywhere here. Like enter right after this. I'm an aggressive trader, so I would enter it after this. But you could have entered right after the retest if you wanted. Stop loss is always below the wick. And TP at 1 to 3 risk reward. And that's for TP1, right? And then TP2 you can extend it 1 to like maybe around this supply area. This would have been my essential target, like the top of this wick. That's nearly 1 to 5 risk reward, and so on. But for the trade we're talking about, for the higher time frame trade, the shoulder, for the head to the shoulder, a really good entry point would have been right over here. So it makes one bottom, pushes up, boom, makes a second bottom, second double bottom. So I usually enter right at this level, like over here. I'll break it down even further. I'll go to maybe 15 minute. On the 15 minute, you can see it makes the first bottom, boom, goes up, consolidates, makes the second bottom. So usually I try to enter it after a really big bearish impulsive move, just because I know retail traders are going to be selling it. So I know the higher time frame bias is the right shoulder, so it's long term, people are looking to buy. The investors and banks looking to buy. But I know the retail traders are going to be on the freaking 5 minute or 15 minute scalping. So I'm going to be doing the opposite. So I'm waiting, instead of a bullish engulf, I'm waiting for a bearish engulf in this scenario because I'm looking for buys. So I get the best entry. So right around here, huge bearish candle, I would have probably entered right around there, to be honest. Just because I'm an aggressive trader and I like to go against the sheep, if you would say. So stop loss would be right around at the end of the zone, about 7 pips. And TP would have been high, but TP would have been based off the higher time frame. So my entry would have been based off the 15 minute. So it's a 1 hour It's a 1 hour double bottom, 4 hour right shoulder. My TP would have been based off the 4 hour supply zone. Because I know I'm entering with the banks. CP would have been right here, TP1 for sure. TP1 would have been maybe right on this wick. Because this wick is like a major 4 hour supply zone, I would say. So supply zone right there, that would have been TP1. That would have hit like, even if it hit 1 to 7 risk reward, that's more than enough. But of course, I always leave the runner running. The runner would have went to like 1 to 14 risk reward. And for that scenario, like if I'm risking maybe 6% on a trade, I'm gonna be returning 84%. So that's just crazy compounding, you know. I can win one trade, I can lose 10 trades, and I'll still be in profit. And this way, suppose I entered here and I got stopped out, right? First time, I could have re-entered again, right over here. And the second trade would have hit CP, so that's why it pays to trade with tight stop losses and big risk reward. And that's just one example of higher time frame analysis. So I'll keep this video not too long. And now it's undergraduate freshman. I tell my students to usually avoid this at the beginning. So yeah, we don't really do a lot of that, like trading news. I try to avoid that unless it's like a account that I'm willing to lose money on, so I don't really mind. But on my investor accounts, on my own account, I highly avoid trading news. Unless I'm already in a position and I put my stop loss to break even, then it's fine. Or have a separate account just for news, where I can risk a bit more and money that I'm not scared to lose. Undergraduate sophomore, I told my guys to also avoid this. We'll look at the US dollar index. I mostly use the US dollar index as a confluence for gold. Let's give you guys an example. So over here you can see gold has been making higher highs and higher lows. Higher high, higher low, higher high, higher low right around here. That's where I entered. Very nice, we're moving up. Floating about 45 pips in profit right now. About 1 to 2 risk reward nearly, but I'm not closing yet. You know, I'm letting it run to 1 to 5. So you can look at DXY. You can also see that DXY is really bearish, made a huge evening star pattern, boom, bearish engulf, making a lot of lower lows, lower highs, and even at the higher time frame. You can see that it made a daily M. Whenever daily M's make, it flies. Daily M flew, daily W flew up, and it repeats that over and over. Daily W flew up. It repeats that. The daily reverse head and shoulders flew up. So same thing again. Kind of like a shoulder, head area, shoulder. So yeah, we're probably gonna fly maybe a bit lower, maybe around, I would say about this area, or at least this looks like a good demand area for the top. The daily, so we make it blue. So yeah, it's pretty bearish until about here. That gives me a good indication. That's the only time I use US dollar index. And equities, same thing with equities. Like equities, US 30, that is obviously correlated to gold. So I also use that as confidence for my trades. So you can see US 30 is flying up. Gold also flying up. So yeah, it's not always right. Like it's doing the opposite right now. This was also a good sell area. Shoulder, head, shoulder, but it didn't really play. I made a lower low, lower high, but you know what? It goes against the grain. Damn, it's the highest high it ever made in history. That's good though, you know? When it reverses, oh man, we're catching them now. All these buyers who are holding positions are all getting stopped out when I enter, you know? It's about like almost 100,000 pips. So yeah, when the reversal forms, you know, you already know we're kicking off that. That's the course outline, undergraduate, junior. So yeah, this is just like developing your own trading plan, which type of trader are you. You guys can go on this go over this on your own. I highly suggest keeping a journal, as it'll help track your progress, help track your trading, help track your technicals, your risk management, and these mistakes you're making, so you can improve little by little until you eventually master the craft. I also recommend creating your own trading system. Like, have my own trading system, Pipionaire FTMM 2.0. I have like 2 or 3 systems within that one system. So I suggest really creating your own on what works best for you, because I have certain systems for certain environments. And some people, they can't trade all my systems. Like, I'll give people both or all 3 systems, and they'll maybe be winning trades on one, and the other one they'll be getting slaughtered. So why would you want to have a smaller winning rate just because of your greed of trying to catch as many trades. Rather, it's better to find perfection. Rather, it's better to get a higher win rate with good risk reward, so it's more profitable, because you want to eventually eliminate losses to the max you can. And of course, develop your own trading plan to save yourself from yourself. Like risk management is key. And that's like a rookie mistake, Undergraduate, senior. So yeah, risk management. Yeah, speaking of the devil. So yeah, risk management is absolute key. Like even if you're gonna risk a lot, like of course don't FMG your account because you'll probably get stopped out. Like right when you FMG your account, you create excess potential in the universe. And when you create excess potential, the balancing forces do whatever they can to neutralize that. And the easiest way to neutralize excess potential created by over leveraging is to blow your goddamn account. Because now you got nothing to trip over. You have no motion on the line, so it's neutralized. And that's what's gonna happen 99% of the time. You might get lucky sometimes, of course. Beginner's luck always a factor, but in the long run, no way you can survive FMGing back to back. And that is definitely the number one cause of death. I didn't even look at this. Position sizing, just use the position size calculator on my FX book. Type in your account size, risk percentage. I like to use 6%, like 3 to 6% for investors. I'm like an aggressive trader, so yeah, I use 3 to 6%, and I have a solid win rate, and my risk reward is 1 to 5. So I know that even if I lose one trade, lose two trades, like one of my wins is gonna cover 4 or 5 of my losses. So I don't mind risking more percentages, because most people will say, "Oh, risk 1% or 2%," but I personally don't find that really working really well, because why am I risking 2% to make like 6 or 8 or 10% when I can be risking like 6% and making 20%, 25%? Like I know losers are part of the game, but the key is keeping your risk the same. Don't be risking 2%, and then you risk 1%, and you might win the 1% trade, but you're only gonna make 3% back if your risk reward 1 to 3. So I suggest highly to keep your risk the same. So for beginners, I would say maybe risk about 3 to 4%. Like I risk 6% now because I've mastered the craft to a high degree. Of course, I can improve my skill set more and more, but for now, I can risk 3 to 6% on investor accounts without any emotion at all. And on my own personal accounts, on smaller accounts under 10K, I risk about 6 to 9%. And then sometimes I also have like larger accounts that I don't mind losing, that are basically for just to follow the plan to see where I can take them over the week. And those accounts I risk up to 16%. So I risk 16%, and with 1 to 5 risk to reward, I make about 80% return. So that's fine with me, like I can lose, like suppose I say I have a $10,000 account and I lose 16%. I lose, boom, I lost one trade. A lot of guys will be tripping. They'll be from 10K be down here, they'll be like, oh fuck, I gotta over leverage to make it back. But that's your mistake. That's where you get trapped. For me, I keep my risk consistent. I don't even look at the numbers. The numbers are just there for me. The numbers are like the numbers when I look at the clock. There's no emotion attached. So I just look at the risk. I look at trading view. I don't even look at my MT4 until I gotta like close, until we're near TP and I want to close a trade or something like that, or make my stop loss tighter and so on. So yeah, like even if I lose another trade, boom, now I'm at 6,800. At this point, people will be tripping. People will be like, oh fuck, I'm down 3,200. And they'll be traumatized, they'll want to risk more, they'll be emotional over their trades, they won't make the right trading decisions, they'll be cutting their winners short, they'll be letting losses run, and so on, moving their stop losses, and so on. But me, once it hits, that's fine. And I'll continue, because I'm not even looking at the balance, to be honest. I'm just looking at the charts, and I just know that 1, 2, or 3 trades, one of them is going to be a winner. So 2 trades, suppose I lose, say it's a bad day, suppose I lose 3 trades, fuck it, I lose 3 trades. Boom, my equity is gone. 4,800, nearly 48% of my equity is gone, nearly half of my equity. At this point, a lot of traders, they'd be done, they'd over leverage to get it back. They'd be emotionally gone. They wouldn't realize how they can build it up. But for me, I know my risk reward is solid, I know my skill set, I know the technicals, I've backtested my system, it is profitable over the long run. So I know win in the long run is inevitable. So at this point, after 3 losses, most times I'll like 99.99%, I won't even get to this point. I'll lose 1 or 2. But suppose we get to 3 losses, next trade, I always use 1 to 5 risk reward minimum. I'm missing 16%. I'll be making 80% return. I'll make 80% return on this. Boom, nearly back up. One trade. Let's say I lose another trade. Minus 16%. Okay, I'm still here. After I lose a trade, let's say I lose another trade. I'm here. Now let's say I win one of my trades. It's 80%. Boom. Now I'm in profit. Now let's say I win another trade. Because I usually win way more than I lose, So 80%. Boom. Now we just did 100% return. Now I doubled my account in like 5 or 6 trades with like 3 winners and more losers than winners. I'm back up. No motion, nothing. Now at this point, you could continue trading that way, or you could, with most people, I would recommend for beginners definitely to withdraw at least half your equity. So suppose you withdraw 5,000. Now you're playing with half the house money. So now let's say you lose again. You lose 16%. Boom, you lose another trade. You're back at 10K. Lost 2 trades, fuck it, you lost another one. Now you win a trade. 80%. Boom, back up. Let's say you lose 1 trade. And now let's say you win 1 trade. Boom, now you're back up 22,000. Fuck it, you withdraw another 5,000. And now you're playing with completely house money. You're $17,000 in profit. You withdrew your initial. You're at $17,000 profit, so you're chilling, And at this point, you should have no motions at all. Like I already have no motions from the beginning, but at this point, you guys should have legit no motion. Suppose you're trading, you lose 1 trade. Fuck it, you lose another trade. Lost 2 trades. Now you win a trade. Lose a trade. Most times I'll be winning like 2 or 3 trades in a row, but for this sake, I'm just gonna give you guys the benefit of the doubt. Say we lose 1 and win 1. Boom, 31K, and so on. And like this, you can compound it all the way to like an infinite amount. Of course, it takes a tight skill set. Of course, it takes a lot of time to learn the craft, master it to get to this level, but it is what it is, So yeah, that's position sizing, setting stop losses. That's key, Don't be trading without a stop loss. Like a lot of guys, they got slaughtered on freaking GBP. They're trying to there's a really good pattern. I was looking at it myself, sell it. Like you guys probably saw this on my Instagram as well. Like I bought it from right here, so right about there, 1 to 5 risk reward. Now I'm trying to sell it over here, but my sell it got picked up. Luckily, no stop loss in profit, so my TP2 hit. I had about 100 pips. TP3 did not hit, so I'm gonna delete this. TP2 hit at 4.66 risk reward, and then if I kept holding it, if I kept trying to add on sells after this level, I would have got slaughtered. I know a lot of people got fucking murked right over here. Boom, shit kept flying up. Like this is because of news. Like, this is very abnormal to happen. Like you're normally not gonna see like a 400 pip candle nearly in 4 hours. It's about 100 pips an hour. Scaling in and out. I don't recommend scaling in and out for beginners. Definitely not. Like if I were to scale in over here, add more positions, I would have kind of got fucked up. I recommend scaling out though for beginners. So I did scale out over here. So basically, once I was up, once TP1 hit, I closed half my position. So I was up 80 pips, closed half, put my stop loss to break even. So I let the rest run, another 20 pips, hit TP, and we're blessed. I actually closed like another 50% of my position, 25% I got stopped out on, but I was already up like at least 85% banked, and the rest was risk free. So I don't mind. I lost. I even slipped my stop loss. I got stopped around here, but it's fine. Overall, the trade was a winner. And currency correlations. It's kind of key as well, as I said earlier about DXY and gold. Another really good currency correlator pair I look at is Euro NSD. This looks like a good buy. I stopped out earlier, but fuck it. The risk reward is 1 to 5, I think. Yeah, 1 to 5. So yeah, I'm gonna be entering again. Probably around here. Probably like, not right now. Maybe around New York session. So shoulder, head might go up. Boom, make another shoulder. So enter right around there. Probably gonna TP about there. Risk towards 1 to 17 right now. I'll give this more room. Probably catch about maybe 1 to 7. 1 to 7 seems good. So yeah, I can afford to lose a couple times. I don't mind, Because 1 win, it's 1 to 7 risk reward. 1 win is gonna cover 7 losses. Like I was doing the calculation earlier with 1 to 5 risk reward. Just imagine with 1 to 7 and so on, you know, like I could even let this run longer to 61.8 and it'll be 1 to 10, but whatever, we don't gotta get greedy here. And then graduation, if you guys don't really need to see this stuff, you could, but I personally don't think it's required for technicals. And yeah, that's about it. So I really want you guys to focus on like a systematic approach to charts and focus on systematic compound, as I was showing you guys an example, like how I was doing it earlier on this. How like just keeping risk consistent and just focusing on the long-term growth, focusing on keeping good risk reward, like 1 to 5 minimum, I would say, like 1 to 3 for beginners. But the higher risk reward you can get squeezed out, the better you will be in the long run, because you can afford more losses. So that gives you more room for error, and it'll also help your psychology. Like you won't be stressing over losers. Like I literally set my trade, let it play. I go to sleep. I'll let it play out. Wake up a couple hours later, either I'm in profit or it's just hit my stop loss. If I hit my stop loss, I'm gonna re-enter again. If I was wrong, I was wrong, and I'll realize, you know. And that's that. And so yeah, that's pretty good for today. Just the basics. And so that's like the end of phase 1. And see you guys in phase 2.